Traditionally, bonds have been a staple when it comes to a balanced portfolio. However, lately bonds have fallen out of grace with many investors. Has their time passed? Or are bonds making a resurgence thanks to bond ETFs? In this video, we will deep dive into bonds and figure out the best way to make some money with them, and we will begin right now. So, what exactly is a bond? It is an opportunity for you to give a loan to a corporation or even a government. With that loan or bond, there is a principal amount that you are lending, there is a length of the loan known as a maturation date, and there is the interest you earn from that loan known as the coupon. Once you purchase a bond, those three data points do not change. Thus, a bond is often referred to as fixed income. Suppose you bought a $1,000 bond in Banana Co. for a 1-year maturation date with a 5% coupon paid out monthly. In 1 year, you would get your principal back, so $1,000, and for the 12 months leading up to that, the coupon pays you $4.16 per month. Your total return is $1,000 plus the $50 coupon. The fixed income of a bond can be useful to offset market conditions, provided you are holding the bond to maturity. You do have the option to sell your bond at any time, but that is where changing interest rates come into play. When interest rates rise, a bond's value moves in the opposite direction. It loses value. If right after I bought that $1,000 Banana Co. bond, interest rates went up, I would not be able to sell my bond for $1,000. I would have to sell it at a discount. If the new rate results in Banana Co. bonds being issued with a 7% coupon, then a new bond would return a total return of $1,000 plus a $70 coupon over 12 months. So if I want to sell the Banana Co. bond that I already have, I need to make up for this 2% change in the coupon. So I would have to sell it for $980. The $20 discount makes up for the difference in the coupon price. Of course, this math does get a little bit more complicated once we've already started receiving coupon payments. There is another risk with bonds, and it all involves the company's credit rating. Buying a government bond is one of the safest options, or if you want to buy a bond from a specific company, a credit rating of single, double, or triple A or triple B is preferred. As you know, there is very little danger of that company defaulting on their bond. When you start buying more risky high yield or junk bonds, you are looking at more dubious looking credit ratings like double or single B, the C's, or the D's. These bonds may be fine, but the risk of them becoming problematic in hard times is greatly increased. One way to try and mitigate the effects of changing interest rates is to look at your bond buys in a ladder. In this case, it is almost like dollar cost averaging into bonds. You may buy a $1,000 Banana Co. bond every 6 months with a maturation of a year on each of those bonds. This way, you are hitting the bond at different coupon rates, thus getting a fairer overall coupon value long term. Another thing to keep in mind is that if you go for longer maturation dates, the coupon value is often higher. That does sound like a lot of work, and for that reason, some people often opt for a bond ETF. Just like a stock ETF, this exchange-traded fund will invest in a bunch of different bonds, often with shorter maturation dates. With a bond ETF, you really don't have to worry about the coupon because they will provide a monthly or quarterly coupon payment in the form of a dividend. This is fantastic. However, the price for a unit of this ETF very much is affected by interest rates. So when interest rates are rising, the ETF is often losing value. Holy banana bread. So how can you make money with bond ETFs? Obviously, when interest rates are falling, you can make money with bond ETFs, but that is really not very useful in this current market where we are looking at a year or maybe a little more of increasing rates. There are really two approaches to making money. In 1 second, I will show you one of them, which is making money with the rates going up. Over on the High Ride channel, Ryan is dropping a similar video to this one, and he is going to show you guys the other method to make money. So as soon as you finish this video, hit the pinned link to go check out Ryan's video, and then you have the complete picture. While you are over there, drop him a like, and you might as well subscribe too, because he pumps out some pretty awesome content and you don't want to miss any of it. Now, let's look at the inverse bond ETF method. I have talked about inverse ETFs in the past, and this solution is pulling a play from that video. An inverse bond ETF is going to make money when interest rates are rising. If you create an overall bond strategy of a good bond ETF for when interest rates are falling and the inverse for when they are rising, you can make a lot of money with bonds. Before I show you the ETFs I selected for this video, let me throw a huge dose of caution your way. Inverse ETFs are like a candle in your house. You never leave them unsupervised. They won't burn down your portfolio, but they do have a little leverage on them, so you can lose money faster when conditions reverse. Inverse ETFs are short-term plays. This is an American play. Honestly, I could not find a good enough Canadian inverse bond ETF to make this a banana bread level of awesome. So I chose both an ETF and the inverse so you can see how they work together. For the bond ETF, I have chosen the Vanguard Intermediate Term Corporate Bond ETF with a ticker of VCIT. This ETF tracks the performance of the Bloomberg US 5 to 10 year corporate bond index. This is a pretty massive fund with a market cap of $40.4 billion. They do provide a coupon-fueled dividend yield of 2.63%, paid out monthly in the amount of 19.2 cents USD per month. They do have an expense ratio of 0.07%, which is absolutely not very shabby at all. As expected, they have been falling as interest rates have begun to rise. In fact, in the last 6 months, their value dropped from $91.62 to $80.01. This is totally expected, so definitely no need to worry. However, when rates are not rising, this ETF tends to rise with some impressive growth. With this strategy, this ETF is only half of the story, and the other half is our inverse bond ETF, which is the PowerShares Ultra Short Lehman 20+ year Treasury Pro Shares with a ticker of TBT. This inverse ETF uses 2 times leverage and provides an inverse replication of the ICE US Treasury 20+ bond index. This is a pretty big ETF with a market cap of $1.4 billion, and they do not provide any form of passive income. They are entirely a growth play. If we look at the same 6 months where the bond ETF fell 14.5%, their price rose from $17.98 to $26.84 for a return on investment of 49.3%. Holy banana bread. Their expense ratio is a little higher at 0.9%. With a return just shy of 50%, I really don't think we're concerned about a 0.9% expense ratio. If we look at their price action together, it is not hard to see just how well this correlation is working. With the Feds looking to continue with rate hikes for the remainder of this year and maybe even into 2023, there is more than likely a lot of upward movement still to come for this inverse ETF. This absolutely looks fantastic. But once again, it is an extreme caution play and needs to come with a very good dose of due diligence. This is not a play for everyone. If you are stressed out easy when it comes to your investments, I would advise that you stay away from plays like this. Slow and steady investing will win the race. This is just one of those little turbo boosters along the way. With that being said, this is only the beginning of your research. A financial advisor is the end. Seriously, talk to a financial advisor before you even think about getting in on this sort of play. If you guys loved this video, be excited, there is way more to come. Until then, why not watch one of these videos? And before you jump into that content, just be sure to like and subscribe to support the channel. I'll see you in the next video.